Hey guys, Joseph Henson here with Henson CPA Group, and today we are going to be talking about the tax trap, avoiding surprises at tax year end, how veterinary clinics can plan ahead and keep more of what they earn. Again, I'm Joseph Henson with Henson CPA Group. I thank you guys for being here each and every week. If you ever have questions, just please let us know. What tax surprises typically happen? A lot of times people are waiting until tax season to start planning. There's some stuff you can do, but most of this needs to happen before you get to that point. People forget about estimated payments that they should be making quarterly. If you make a certain amount, you need to pay in 110% to avoid penalties and interest, not accounting for owners' draws or distributions. These are non-tax issues, but that have a large effect. If you take out every dollar you have, a lot of times you'll find that you don't have cash on hand anymore to handle the distributions. Plus, if you take out more than what you really should, you run into capital gains and other issues as well. And then assuming profit equals cash available for taxes. I made $100,000. That means I have $100,000 in cash in the bank. Not always, not even generally. The profit versus tax disconnect. The IRS taxes your profit, not the money you have in the bank. They don't care about cash on hand. They care about profit. Loan payments, equipment purchases, owner's draws, these do not reduce taxable profit generally. You can look at some equipment that could potentially reduce taxes. Some of the loan payment could reduce taxes. This does create a gap. Plenty of cash is spent, but taxes can still be owed. Common mistakes veterinarian clinics make: not setting aside cash for taxes throughout the year. They're living in the here and now. They'll worry about that when the times is ready for it. Misclassifying expenses or missing deductions. We're a CPA firm. We specialize in helping you reduce taxes, but we also do not audit your books. We can't say what you're doing is wrong unless you're telling us, hey, what about this issue? If you do that, we can say, no, you can't do it that way. That's not going to be tax deductible. If you're going out and spending $10,000 on meals every year, only a portion of that's deductible. Another thing they don't do is wait. They're waiting until year end to review the books. Monthly, quarterly, at a minimum quarterly, but truly you should look at your books on a monthly basis. And then also, they don't take into account the state and local obligations. Not all states have state taxes. Not all local cities have taxes. But you do need to be aware of those before you actually decide you're going to file. You could owe California, for example, $20,000 and not think about that when you should have been paying it throughout the year. Here is a tax timeline. You have taxes that are due on April 15th is when the estimated tax is due. Your next one is going to be June 15th. September 15th is third quarter. And then January 15th is your fourth quarter estimated tax due or estimated tax payment. You then get to when are taxes due for that entire year. They're an annual filing deadline, typically March 15th or April 15th, depending on if we're talking about your business or talking about your personal returns. You need to at least plan on a quarterly basis and not annually. Estimating taxes, these are your best friend. It breaks tax liability into manageable payments. If someone comes to you and says, hey, I need a $50,000 check today, that can be overwhelming. But if they come to you and say, hey, I need a $12,500 check today, in 3 months, I need another $12,500, in 3 more months, $12,500, you're paying the same amount, but you're breaking this up in a way that makes sense for you and your business. This will also help prevent big year-end surprises. You're not getting that $110,000 tax bill. You're getting this throughout the year and planning accordingly. Paying these estimates in will help you avoid IRS penalties for underpayment and any interest that accrues. The best practice is to base estimates on current year profit, not just last year. If you're outperforming last year by 10%, you need to take that into account when you're making your estimates. Deductions and opportunities. Section 179 for equipment purchases. This will allow you to completely write off the equipment you purchased this year with a few caveats. You can also do bonus depreciation. It's back to 100%. Retirement plan contributions for you and your team. Retirement contributions reduces the taxable income in the business. Business use expenses. You should be looking at your vehicle usage and making sure its business portion is being accounted for, and a home office if that's applicable. A portion of your home can be used for that. And then tracking expenses properly will save you more legally. We don't want to fudge numbers. We want to know what you're doing is legal and right and within a margin. Building a tax reserve. You should be looking at setting aside 20 to 30% of profit for taxes. If this quarter you made $100,000, you should be putting aside $20,000 to $30,000 for taxes. This is a good baseline, so you know the cash is there. Every week you can even do that. Hey, I made $10,000 this week. Take $2,000 to $3,000 of it, put it into a tax account. Keep a separate savings account just for your tax funds. This way, you don't get tempted to dip into it, and you can even set up auto payments for your quarterly payment. And then another thing you should be looking at is automating transfers monthly or quarterly for that tax. So even if that's $1,000 a week, $52,000 a year, playing with that to make sure you're not getting hit with a surprise. Key questions you should be asking yourself for your clinic. Do you know your projected tax bill right now? Are you making quarterly estimated payments on time? Are you maximizing deductions without raising red flags to the IRS? Do you set aside cash specifically for taxes, or are you playing the game where you just see how it's going to go? You're going to take that opportunity later. It's not a you problem today, it's a future you problem. If you take into account even 3 of these 4, you're going to be doing much better than you were yesterday. If you take into account 4 of 4, you can start to truly minimize your taxes and only pay tax on the portions that matter. That is it for today. I really want you guys to plan ahead. Don't get caught in the tax trap. We help veterinary clinics stay ahead of taxes, avoid penalties, and keep more of their hard-earned money. Again, I'm Joseph Henson with Henson CPA Group. If you have any questions, feel free to email me at joseph@hensoncpa group.